all those relationships to all those different entities, both corporate, government, and academic. That is the secret weapon of the Bay Area and why all those companies come here as to interact. So now what we're going to do is we're going to bring up and have a chat two esteemed gentlemen about finding the balance between VC and CVC for successful syndicates. So the moderator is going to be Michael Fox, and the other gentleman is Louis Resi. So come on up, guys. I'll let Michael introduce the topic. Thank you. I think they're both working, so you should be set.
Yeah. Ralph is amazing, isn't he? He actually managed the CTO at HP. By the way, it's pronounced Louis Resi. It's taken me decades to get it right, but I'm still a work in progress. Thank you all for joining us. For those of you who don't know me, I'm a troublemaker, and I sort of sit in both worlds, and that's one of the reasons why I had an opportunity to meet Louis. I've been 20 years, 15 years, too long. A thought leader in corporate venture, and now my group is with 3 funds in China. But Louis is an anomaly and a real asset to both communities. He's a recovering corporate VC. He was with Mustang, the early stage Siemens Group, and then parlayed his position to Forte Ventures, which is actually a bridge between corporate and institutional. So you're an institutional, but you understand you're recovering corporate. Why don't you explain you can do a much better job than I can. Tell a little bit about Forte, yeah?
Sure, thank you for the opportunity to speak. Is this Are we live? There we go. Thank you for allowing me up to take some of your time this morning. Yes, as Michael said, with a small group called Forte Ventures, and we're speaking about the interaction with corporates because having been from a corporate world, we actually built a fund around the idea of basically collaborating and co-investing with corporate strategic investors. So we invest broadly across stage and sector, but we only do it alongside the corporate. So we've done auto tech deals alongside GM and Porsche and BMW. We've done insurance deals with Allianz and Liberty Mutual. So we've got a lot of relationships in there, and we basically fell into the strategy from having been within the Siemens organization doing a benchmarking against what you saw was a growing list of corporates out there and trying to understand best practices. And what we found was when we looked at the different corporates, there were as many different strategies for how to build one as there were corporates out there. And so we realized that there wasn't necessarily one great strategy and everybody else was doing the wrong thing, but that each one had strengths and weaknesses, and that as an institutional investor and a partner to those groups, we could help bring in those strengths into syndicates that we built for some of our investments and take advantage of the things that they bring to the table. So we've built a couple of funds now around the idea of this co-investment strategy with strategics.
So Louis and I have been collaborating for a long time, and one of the things when I look at Louis and what he's trying to do, to me, it's really about setting expectations, not only with potential opportunities, but also with the corporates. And of course, for those of you who track it, the corporate venture world has been undergoing a seismic shift. In 3 years, from 2013 to 2016, the B round literally doubled 100%, and the C round and the B round grew 60%. And so clearly, it's not the 3Com investment of the 90s where it was all M&A, and it becomes an imperative to be able to manage those expectations. And part of that has to do with understanding the needs and desires of the corporates, and being someone who's been on that side of the fence, it's almost a dark art, right, to try to understand the DNA and what their agenda is, because the last thing you want to do is have disparate expectations. So how would you address that, and how would you think about it in terms of building a syndicate that makes sense?
Well, I think not surprisingly, the corporate venture arms are going to mature over time. As the organizational goals change, you're going to have changing goals and priorities around the investors that are part of that strategic syndicate. And so in order to make sure that we're both bringing the right kinds of opportunities to them and setting expectations on the deals that we're getting into, we need to stay current with what those changing trends are. So that really is nothing more than just kind of maintaining those relationships and understanding how the priorities are shifting. And those priorities might be around strategic areas of interest to look at new things that maybe they hadn't in the past, or it may even be around things like shifting priorities about stages that they might want to get involved in, shift between focus on financial versus strategic returns, things like that. And again, there's no right answer, but as far as whether or not there's interest in them being part of a particular investment syndicate or what they would actually bring to it, you just need to make sure you're playing matchmaker in that regard and trying to find the right opportunity to fit with the current strategic goals.
Well, so one of the challenges I've seen in the past where it's been as yet unsuccessful or it's been a train wreck is when you have disparate expectations. The strategics exist across a spectrum of value from the very tactical to the very strategic, and even some of the institutionals have a strategic agenda too. Trying to manage those expectations and trying to set the chemistry for it. I mean, that's the question. When you look at a given opportunity, how do you engage with them in terms of whether it's trying to aggregate the right kinds of syndicate together? The last thing you want to do is see another clean tech initiative where they're looking for a 3 to 5 year return on and that was more of an institutional problem rather than a corporate one. But it comes back to the setting expectations. And so one of the things I've watched Lewis do when we look at opportunities together, he's already thinking about it in 3 dimensions, and it makes it look very easy. But trying to understand with your knowledge base of the different corporates and what their agenda is, how do you determine that across the spectrum?
Well, I think, again, we're playing kind of a matchmaker role in some of these where especially if it's a deal that we are finding and trying to find the right strategic partners to bring in versus the other way around, which also often happens where a strategic would come to us as part of a syndicate and they've already identified the value and interest in getting involved in a particular company. But understanding what a company needs and who's going to benefit most at the right time, because one of the things to realize is there's kind of an impetus mismatch between a lot of these early stage companies and the big corporate strategic investors. If you have a team of 15 people doing an A round and they're talking to 5 Fortune 1000 companies, obviously any one of them could overwhelm the startup company with what they're trying to do and the number of people they're bringing in and the amount of interaction that they have. And so trying to make sure that you're bringing the right people in at the right time to sort of ensure success on both sides is part of, as you said, the dark art. But I don't think there's really any trick to it other than making sure you're having those open conversations in the beginning and making sure everybody's going into the deal with the right mindset and the right expectations.
Let me ask one more question, then we can talk about some process and how one exercises. So one of the challenges I've seen historically when corporates explore opportunity is trying to find a balance between their agenda for strategic investment, which might be differentiation or extended product life cycle, whatever that might be, and gee, they know how to monetize in their business unit, and answering to the issue of fiduciary. Is somewhat in diametrically opposed forces. How does one navigate that in terms of setting expectations at the front end versus, you understand?
Well, so I think, again, those are not necessarily opposed forces if it's done in a way that has the right kind of balance. I think the best way to think about that is, for me, as an example, if you have a company coming in with an investment that wants global exclusive distribution rights for a particular product, if they don't perform, obviously that hamstrings the company and can actually be problematic. But that doesn't mean that there aren't some levels of exclusivity, there's some levels of benefit that they're going to be getting that go along and correspond to the investment. Otherwise, the corporates would not actually want to do the deal. So the trick is trying to find that mutually beneficial balance, and it varies from deal to deal. So we've done deals where you might have a particular market exclusivity for a certain period of time, right? You might have some pricing advantage that goes away over time, or is related to some sort of performance metric, right? Hitting a certain level of revenue milestones, something that is actually beneficial to the startup as well, but allows the relationship to get going. So you want to make sure that whatever you're doing that puts in place provides the strategic value, but does not become an anchor on the company that prevents them getting the future financing they need, or prevents them potentially finding an acquisition partner down the road.
This is why I like working with us. Just Switzerland and compromise. So you're neutral in many respects also, and I've seen this happen when you bring in an aggregation of different corporates. You're neutral in many respects to be able to find where that compromise, the best pathways lie. So I think it would be really helpful. I'd love to hear it too, in terms of examples of things that have worked in harmony. And one of the things that Louis doesn't wear on his sleeve, but he draws different lines in the sand in terms of how they look at the relevance of how much of a deal, for example, and where to play. And it impacts not only percentages, but it also impacts when you play and the position you take.
I think what Michael's referring to is that we're a little bit unique with respect to some institutional funds, that we don't have sort of strict guidelines around stage that we invest in, dollars that we're putting to work, or percentage ownership that we have. So we're a relatively small fund. Our current fund that we're working out of is about a $45 million fund, and so we're not writing $10 million checks alongside Microsoft and Verizon. We're typically writing the smaller checks, but we're putting things in place in a way where if we are getting a smaller percentage of a later stage company, we still have to believe in the upside value. We'll come in alongside them in earlier stages as well. We do lead and take board seats if that's a benefit to the corporates, but the key for us is we want to make sure that we're building the right syndicate, and that the syndicate partners are getting what they need out of the deal. And in coordinating that role, we can play a variety of benefits for them as well. And some of those, again, may be things like taking the board seat as a proxy. But we're certainly not going to come in and try and compete on a dollar-for-dollar basis along the corporates, or try and muscle anybody out of the deal, right? The trick is finding that balance that works for the entrepreneur, finds the strategic benefit and balance, and also still provides us upside. And so that Switzerland role that you talk about is one that comes in that says, I'm not necessarily going to benefit from the strategic value that the strategic is getting. So as an example, if they invest in a startup company that they're going to then be able to sell through additional products of their own, it may very well be the case that a $5 million investment could be written off completely in a year, and it's still a good idea to do it because the business driver is enough to overcome the write-down of that investment. Obviously, that doesn't work for us because we're not seeing that benefit. So we play a little bit more of a neutral role in making sure that the terms that are agreed upon are ones that work for both the startup and the institutional that we bring to the table.
This is why I want to talk about setting expectations. Louis, it's been a pleasure. Thanks very much for your contribution.
Thank you.
Thanks, guys.
Okay, dark arts. Who would have thought you woke up this morning and would learn some interesting things? One of the things that popped out for me is this balance in finding the beneficial points that drive value for both the investor and the inventors. And that balance point is probably not on a 2x2 pendulum, but it sounds like a complicated